Well, thank you for joining me today at this week's weekly update. It's the last week of October, and we're going to get right into it. If you have questions, make sure to send them here. So, if the Fed cuts rates, how much cash should I keep around? Now, it's Wednesday morning for me, so I assume the Fed's going to cut rates this afternoon, as most people expect. If they don't, this video is going to look a little bit awkward, but regardless, I think most people are under the understanding that the Fed is in a rate cutting cycle. And that does mean that we're probably going to earn less on short term cash funds. But this question has been plaguing me because the question is how much cash should I keep around? Allocation is a determination of circumstances and goals, not of our expectations of the market. What do I mean by that? The follow-up question, how much should I have saved in my emergency fund? That's determined person to person. It's between 6 months to a year, and depending on several circumstances. What's the likelihood of you needing it? What's the likelihood that, what other sources of liquidity do you have? Nobody wants to need the money out of their investment account in the bottom of COVID or in the bottom of 2022, right? Where else can you get liquidity if you needed it? The real question is going back to allocation. How is allocation determined? And there's a couple of different ways. One of the methods that is commonly used to help explain it is called the 3 buckets method. It's pretty simple. What are your short-term goals? What do I mean by short-term goals? Possible emergency. What about my taxes due here in a few months? I mean, April's not that far away, right? January 15th for those of us paying quarterly taxes. What should my money be invested in for those couple of months? The answer is probably next to nothing because we just don't know what's going to happen over that period of time. There are stocks that fall out of the blue even after being very consistent for years. Some rise, but the misses, right, of missing big rises are probably not as bad as getting hit by a big shortcoming. Medium-term goals, right? Saving for a home in a few years. I've got college for my 7-year-old coming up. Well, I've got 10 years for that money to grow. Should that all be invested in cash? Do I need it quite this minute? No, I've got 10 years. So it's more blended, right? There are some short-term pieces in there, but there are more long-term. The more toward long-term, the more usually toward equities you lean. Because if somebody's 7 years old, they've got 10, 11 years before the first payment is due. We can give it some time to grow. As we get closer and closer to that date, as you have a 17 or an 18-year-old, that probably needs to be more and more conservative, more structured around bonds, more structured around cash, getting ready for those distributions. Nobody wants to make a tuition payment, right, if they're 100% invested in stocks in, say, March of 2020, right at the bottom. You don't want to have to liquidate during those periods. You want to have liquidity when there are bad times. And then long-term goals. What are your long-term goals? And then what is this money earmarked for? Retirement accounts are an interesting thing. Millennials, and I can pick on Gen Xers as well, because the numbers are about the same. Millennials are ages basically 29 to 44, and Gen X is 45 to 60. Yes, 60. When surveyed last year, almost a third, 31 and 32% respectively, of their retirement accounts, their 401k balances, were invested in the stable value fund or cash. The stable value fund is a term for a cash-like investment. A third. Now, you can make some arguments around the Gen Xers who are just turning 60. They might need that money relatively soon. But the ones turning 45, they can't touch that money till they're 59 and a half. They're not really supposed to dip into those accounts. And for many people, RMD age doesn't start till 75. And for millennials in their 30s, they got 20, 30, 40, 50 years, depending on how you measure it, before they really need to access most of these funds. And even then, that's some of the first time they need to access these funds, not the funds during their entire retirement in their 80s and 90s. What should that be invested in? The answer is the old joke, time in the market versus timing the market. Yes, we've talked a lot about how we think the market might be a little overheated recently. Yesterday, 80% of the stocks were down while the market was up, meaning the breadth was not very wide. It was just a few big stocks at the top that went up. There are concerns out there. But if you put money in November of 2007 or January of 2000, March of 14, pick February of 2020. Pick a time. All of that looks like a good idea now, several years later. Right? Yeah, November of 2007. Yeah, right before 50% decline in the market. But the market's up substantially since then. Right? We're closing in on possibly 7,000 on the S&P 500. So, yes, it's been a huge move upward, but that's time in the market, not timing the market. It also goes back to how is allocation determined? Why would I use those three buckets? It actually comes from something like this chart. I'm going to zoom in on this one. This chart is the range of returns on a rolling basis, basically for most of the modern era, back to 1950. If you look at in a single year, right, peak to trough, or we could be up as much as 52% or down as much as 37% in a 1 year basis, a 12-month basis. That's a big range. And that's why when people say, what should I be invested in for, an expense I know I have coming up in a few months or 6 months or maybe even a year? The answer is we could be down 37%. It's tough for me to tell you to do much of anything with it. From a bond standpoint, bonds are in blue there. They can be up as much as 33 or down 13. Still, it's a big volatility swing. And a 60-40 portfolio, up 34, down 20. So on a 1 year basis, it's hard to tell where the market's going to go in what direction. But if you look at 5, 10, and then 20 year all the way on the right, you notice the band gets a lot smaller, and more importantly, the number of times it hits zero on the 20-year mark. There's no time since 1950 you could have put money in any of these things, and 20 years later, been negative. Right? As a matter of fact, even the stocks and the 60-40 portfolio, the lowest return was 6% annualized or 5% annualized returns. That's pretty good. But importantly there, stocks would have been up on average 11.6%, bonds 5.2, and 60-40 at 9.4. Those don't sound like bad returns. Bonds 5.2, that's not bad. Well, again, this is about aligning your goals correctly. If you really have 20 years for a goal, $100,000 grew to almost $900,000 over that period. Bonds only grew a little over $250,000. You're missing almost $500,000 of returns by being too conservative over that 20 years. And even a 60-40 portfolio, so 40% of it's invested in bonds, you're up $600,000. You're still shy by $300,000. Right? So again, if you're about to retire, yeah, you want to have money that you're going to need. If you're about to have a major expense, you want to have money that has liquidity to it. But if you have money that really is earmarked for 20 years out or more, you want to make sure that it's allocated properly. Even if it goes down here in the next few months, it probably is going to look pretty smart 20 years down the line. Sort of like investing in November of 07. 18 years later, it looks pretty smart. And then lastly, about timing. Again, time in the market, not timing the market. This is a chart going from 2000 to 2023 of investing only $12,000 a year, so about $1,000 a month, but always doing it. And the first example, perfectly timing the market, meaning you always pick the market low. Every single year, you know how to time the market. You pick the market low, the best time to buy for 23 straight years. It's not really possible, but let's assume you did it. Then contrast that with the worst timing. So you keep investing every year, but you keep getting it wrong. You always invest at the market peak. You keep picking all those wrong times over and over and over again. It's the difference between having 1.2 million and a little over 900,000. There's a pretty fairly sized gap there. Both would be almost near impossible to accomplish for one side or the other. To always pick wrong on the upside or to always pick wrong on the downside. But the consistency is more important, because what if you held on to a bunch of cash because you had a overly sized emergency fund and you never wanted to be without liquidity? Well, this is what 3-month U.S. Treasury bills would have done over that same time period. You're up 330,000. So what does this really tell us? Again, time in the market, not timing the market. The worst investor you could imagine is better than somebody who wasn't an investor at all by almost 3 times. So as a reminder, the cash question, How much cash should I have? It's determined based on your allocation. After you satisfy things like your emergency fund and take care of liquidity, then it's about what goals do you have in the future? What liabilities are out there, right? Whether that's taxes, saving for a home, college education, a wedding coming up for somebody, or your long-term retirement. Aligning those goals with those earmarked funds is very, very important. So hopefully that helps answer the question how much cash people should have around, because yes, you are about to get less as a percentage on cash if the Fed continues to drop rates. With that, 400-year history of American capitalism, Americana, great book. Go watch it right here. And with that, we'll see everybody next week. Thanks for joining me.